But now it's time to bring in our next guest. That's going to be Marc Chandler, Chief Market Strategist at Bannockburn Global Forex. Welcome back to the show, Marc.
How are you?
Great. I wanted to get your take real quick before we start diving into the dollar and some other items here. Just the equity markets in general, we're just below all-time highs in 3 of the 4 major indices. I mean, what's your take? Is the optimism warranted at this point?
Yeah, isn't it incredible? Last year, fourth quarter, as the market was pricing in this Fed pivot, interest rates fell. So, of course, makes sense stock market rally. But so far this year, interest rates have corrected higher, and the stock market still has gone higher. I follow that stuff about the lack of breadth in the market, but it seems to me that's often the case. So I'm a bit lost here. Frankly, I still put money in, like I think investors should, into the dollar cost averaging schemes of 401k plans. But these kind of levels scare me.
And I say that all the time, Marc. You know, I've been in the business and a trader for years and years. I get a little bit skeptical when I see, markets at all-time highs. You mentioned the yields, where they are. The 10-year above 4.2%. That's remained firm. It doesn't seem to scare off the markets. Is that one of the components here where if the market gets comfortable with that soft landing narrative, yields are where they are, the dollar is where it is, that's part of the reason. Once the market gets comfortable at these levels, that provides more optimism and the wealth effect that's created with the indices just at or near all-time highs, right?
I think that makes a nice narrative. I wonder, though, how much of this is really based on these kinds of macro issues? We talk about the lack of breadth, and I think this is one issue that people still struggle to get their heads around, whether we're talking about the valuation of the stock market or inflation. I think that the challenge is that we don't live anymore in the United States in a free market, small businesses dominating, where everybody is price takers. Instead, we live in an oligopolistic, where a few companies dominate many industries, whether it's AIs, whether it's chips, whether it's food processing. And I think this really is a big factor. And I think that the stock market, I want to say it's almost like it wants to go up. There's not much else for people to put their savings right now. House prices look stable. Bond yields are, while they're higher, they're still too low for many people who think about retirement. So I think the stock market is really the place to be for a lot of savers for the long term.
Definitely, and they've shown their optimism with their bids into equities at this point. But Marc, let's move over to a discussion about the dollar, because I think that's one of the things that I've been watching recently. We did see that dip at the end of 2023 as markets were rallying, equity markets were rallying, got near that 100 level for the dollar, but it's firmed up. We've been in a tighter range between about 104, 105, and about 103 seems to be a bottom here. What's your outlook here for the dollar and the impact that it's going to have on the equity markets?
Sure. So I think that what's helped drive the dollar lower in the fourth quarter, drive the dollar higher so far this year, has really been expectations about Fed policy. At the end of last year, in December, the Federal Reserve told us they would likely cut rates 3 times this year. The market, at the very end of last year, was pricing in 6 and maybe 7 cuts. Mm-hmm. And sometimes, and especially in the foreign press, the Federal Reserve is criticized for being a slave to the markets. But once again, the markets have converged with the Fed. So right now, the Fed funds futures are pricing in 3 cuts this year, plus a little bit more, plus they call it a 1 in 3 chance, 1 in 4 chance of another cut. I think that move, that adjustment where the market has converged with the Federal Reserve is over, or nearly so. And starting today, we should be getting a batch of economic data that shows the U.S. economy is slowing, not a recession. Very rarely does the U.S. economy go into a recession in a presidential election year. But I'm looking at a big drop in Boeing orders to drag down durable good orders. And next Friday, the 8th, we're going to get the jobs data, and it looks to me like we should be expecting something about half the pace of job growth that we saw last month. I think that caps U.S. interest rates and also then caps the U.S. dollar.
And you wonder what that impact is going to have, because if interest rates start falling and the dollar starts falling, it seems like investors recently have given that the green light for buying into equities at this point. So we'll continue to watch that narrative. On the flip side, you look at Japan, the Nikkei hit record highs again. The 2-year yield hit highs that we haven't seen since 2011. hotter than inflation inflation data over there. I mean, what's your take here on some of the overseas markets? Because we've seen a bid go into China also recently.
So I think what's interesting to me is, every country had its own institutional framework. We used to talk about the Fed put. Back in the 80s, we talked about the Plunge Protection Committee in the U.S. that prevents the stock market, a sharp stock market sell-off. You talk about the new record highs in Japan, and there we know that the Bank of Japan owns something like 2/3 of the equity ETFs. Equities make up about 20% or so of the Bank of Japan's balance sheet. So then we come to China, and of course the U.S. animosity towards China and whatever China does, but China has done more or less the same thing with its state-owned, state sovereign wealth funds, state pension funds, buying stocks, and so that's also helped lift the Chinese stock market. So I think that this is a global phenomenon. Countries have to react. Even I think that the Fed put is still in place, and by the Fed put, I mean if the stock market sells off and it threatens financial stability, the Fed will adjust policy accordingly. And so I do think that the news from Europe and Japan is poor. Those economies are stagnating. Look at what's going to happen, though. This year, the U.S. budget deficit above 6% of GDP, twice what it is in Europe. And so I do think, though, a lot of the good news for the U.S. dollar is priced in. I'm looking for the euro to begin moving its way higher, not because of good news from Europe, but like what we saw in the fourth quarter last year. The dollar is really driven by what happens here in the U.S. and Fed policy outlook.
Yeah, when you talk about the dollar falling, potentially yields also pulling back, what kind of levels are you looking for in the 10-year at this point? Because I'm curious about that narrative. If we see that 10-year get below 4%, does that provide a lift, or does that signal a warning sign for the equity market?
Yeah, I think that when interest rates fall, equity markets like that, even though U.S. corporates look at the S&P 500, they've got a cash surplus. So we've got the government sector in debt, household sector in debt, while you got the surplus in the corporate sector. So higher interest rates, I should say that corporate America, the large corporations, are relatively immune to short-term moves in interest rates. But I think it just plays on market sentiment. So in a lower interest rate environment, markets like stocks, because of the competitiveness of interest rates and equity prices. And then as interest rates rise, the market says the economy is going well, and that's going to be good for profitability. So I really think that the issue now is how much the U.S. economy slows down. And I think that, like I say, I think it's going to be we're going to begin seeing that evidence beginning to accumulate, starting with this report in about 10 minutes.
Okay, great stuff. As always, Mark, appreciate you being here today.
Thank you. Good luck to everybody.
Yeah, thank you. That's Marc Chandler, Chief Market Strategist at Bannockburn Global Forex.